This is the Empowering Healthy Business Podcast, and I'm your host, Cal Wilder. Each episode, we'll dive into topics important to folks who want to run businesses that are both nicely profitable, sustainable, and scalable, and who want to achieve balance in their lives and realize their potential inside and outside of work. This show is sponsored by SmartBooks, provider of bookkeeping and accounting for businesses. Let's get started. Welcome, listeners. As you know, here at the Empowering Healthy Business Podcast, we focus on ways business owners can drive long-term success in their businesses. And sometimes that could be a foundational topic like how to get accurate and useful financial reports on a timely basis each month, or stay in compliance with tax rules. Or sometimes it may be more of a growth item like budgeting and using financial metrics to make business decisions to drive growth and profitability. And sometimes it's more of a keep item where you want to minimize the amount you need to pay in taxes or manage risks that could be very costly if you get hit with one of them, right? So today's episode is going to be more about keeping more of your hard-earned money by minimizing taxes through figuring out how to take full advantage of home office expense business deductions. So this episode's geared toward business owners who have some discretion about how the business pays for certain of those expenses. So joining me today is Greg Reed, head of tax at SmartBooks, to help us understand how we can take advantage of those home office tax deductions. Welcome back to the show, Greg.
Thanks for having me. Happy Friday.
Happy Friday. I mean, as everybody knows, working from home is more prevalent than ever. And it's really become more of a permanent item for a lot of people, not a temporary item that we might have thought it would be a few years ago, right? So I think this is a very important topic to clarify what's possible, because I think there's some misconceptions. I feel like business owners, some of them are not taking full advantage of this opportunity.
Yeah, talking to a client a few weeks ago, they were saying that, I can't take the home office deduction because I have an office, for the business. And I'm like, no, that's not true. You can absolutely take the home office deduction. And, all those years, missed opportunities, a little bit here and a little bit there, all adds up.
So where do you want to begin here?
So first I want to kind of shift gears a little bit, because this is something that we've heard rumors about. I didn't know if it would actually go through, but kind of hot off the press, as of September 30th, it looks like the IRS is no longer going to accept paper checks. So that would include, I would assume, like estimated tax payments. When you have to pay your tax bill in April, if your accountant is giving you a voucher and you have to mail that in, then that's no longer going to be an option. You're going to have to go online and make those payments electronically.
Whoa, that's going to be a big change for a lot of people in this country. Wow.
Yeah. And then the other side of that is, if you're getting a refund, they're no longer going to issue checks. So you're going to have to make sure that your direct deposit information is updated, and you've got all those boxes checked. I'm assuming you'll still be able to send in paper checks to state governments. Those are usually a little further behind, but definitely a big change for a lot of taxpayers.
All right, well, back to home office deductions, where we can save some money and not worry about how we're going to pay the money.
Yes, so hopefully with the home office deduction, there is no mailing in checks. Maybe you'll have to make sure you get that direct deposit updated so that they can get that refund. But so like I said, client said, nope, can't take the home office because I have an office. That it's incorrect. If you have a place of business, you can still take the home office deduction. So what?
And Greg, just to clarify one thing, because people my age or older, we still remember there being like this official home office deduction with the IRS like 20 plus years ago. But I think what you're talking about is not like a particular IRS program or election. It's just general business operating expenses that happen to go toward a home office, right?
Correct. Yeah. So I think what you're referring to is the unreimbursed employee business expenses. Um, that was an old rule prior to the Trump tax cuts. Um, it was an itemized deduction. It was exactly what it sounds like, unreimbursed employee business expenses. People probably took advantage of it, but now this is really just for business owners.
Okay, good to know.
So the first question is like, what qualifies as a home office? So you're gonna look for, an area of your home that's used regularly for business, exclusively for business. Um, doesn't necessarily have to be your principal place of business, but you do have to conduct business there.
Your dining room table doesn't really count, right?
It would be a hard one to justify, but maybe you're standing up to eat every night. Yeah, really, like if you have a room in your house, that's your, and there's de minimis use too. For example, I'm recording from my home office right now. You'll if I don't know if you can see the camera, but I've got like my golf clubs back here and stuff like that. So like some de minimis use, but for the most part, this is just used for SmartBooks tax. So the next question is, what are the expenses that we can actually take, right? So there's two sides of this coin. There's the real estate side, and then there's the stuff in your home office. So what's the stuff in the home office? If you buy desks, chairs, computers, printers, file cabinets, furnishings for the home office, whiteboards, stuff like that, chances are you're already going to run a lot of this stuff directly through the business, which is what I recommend. But if you're not, maybe you're at Costco and you see a good deal on a printer and you don't have your business credit card with you. Those can all be included as a home office expense. A little caveat to that. I don't know how many people are going to actually do this, but if you have a piece of furniture that's not used entirely for business use, you can absolutely take a portion of that. So if you buy a very expensive desk and you're using it, 80% for business, you could take 80% of the cost of the desk. Again, I think we get into some de minimis rules. Chances are you're not buying furniture that's that expensive, but something to think about. If maybe you buy a desk for the family and kids are doing homework there or something, and you want to be a little cautious with the expenses that you're taking.
All right, what's next?
So then we get into like the real estate side of everything.
Now, this is probably going to be more potentially some newer information. Like you said, I think most people are already expensing their home office equipment and supplies, but now we're talking about the real estate.
So now we get into the real estate. So what can we take? We can take mortgage interest, rent, real estate taxes, utilities, homeowners insurance. If you have an alarm on your house, um, home office repairs, stuff like, that you're doing to the entire house, or expenses for the entire house, you're going to take a portion of those expenses, right? And the idea is that you're going to take the square footage of your home office divided by the square footage of living space in your home, and that's going to be the ratio that you use. So, you have a 1,000 square foot home and you have a 100 square foot home office. 10% of all those expenses that I just mentioned are now a home office deduction. A few things to note on that: you don't have to include non-living space areas in your home. So that would include like decks, stairways. So the idea is to kind of get that bottom number a little bit lower so we can increase that percentage.
Realistically, what's the range that you've seen people report?
I've seen typically like 10 to 20%. If you're renting in an apartment and maybe it's like a 2-bedroom, that number might get a little bit higher, but yeah, I mean, typically it's like 10 to 20%.
Yeah, it would be hard to probably justify more than 20% unless you're in a unique situation.
Yeah, and now I do have some clients that use, like I have a construction client who uses their garage for all business. They store materials there, they store tools there. So we do include the garage space as part of that home office. You can depreciate that portion of your home office over the 39 year for commercial real estate. It does impact you if you go to sell your house in the future. You can't use that as a deduction. So you have to remove it from the basis of the home.
So let's talk through an example here. Just a couple questions I've got for you, Greg. Let's say I bought a home for $500,000 10 years ago. So my basis, so to speak, is $500,000. And we'll worry about the land later. Let's just say we have a home for $500,000. But that was 10 years ago, and now I've started a business, and I'm working out of the home, and I can justify 15% of the home as my home office workspace. But the home is now worth $750,000. Now, can I start depreciating 15% of $750,000, or am I stuck depreciating 15% of $500,000?
So it's the lower of cost or market. And so you're going to go with the 500 in that case.
Okay. And now I bought a house on a piece of land. And so if I remember correctly, land is not depreciable, right? So we have to split the 500 between the house and the land, right?
Yep.
And so a lot of complications there. How would you go? If somebody thinks this could be a meaningful opportunity for them to take advantage of, how would you suggest they go about determining the split between the house and the land?
You could certainly try to figure out what the land values are in your area.
But it would have had to be the land value 10 years ago, not now, right? So
Yeah,
it's tough.
Yeah. Honestly, what I'd say in our trade, we're always looking at like 20 to 30% being apportioned to land. We throw something to land. If you're in a metropolitan area, you're putting a little bit more. I think the land is a little bit more valuable in Boston than it is here in Whitman. So certainly, probably want to take that into consideration. But I'd say for the most part, anywhere between like 20 to 30%, is a safe bet apportioning to land.
Cool. Well, that's a new one. I hadn't really considered that one before.
Yeah, some people don't take depreciation. You don't have to necessarily, but like I said, it's an additional deduction. It's just something you have to consider if you go to sell your house in the future. Now, I think where like this could become an issue is if all of a sudden, maybe you haven't ran your business in 10 years and then, now you're selling your house and you're like, oh, well, there's some depreciation that I have to add back to the gain on the sale.
Right. And you may or may not remember to do that, so it's kind of a messy situation.
A little bit of a messy situation. Again, I don't know how many people are looking at that, but certain, if you're trying to stay to the letter of the law, you have to keep that in mind.
All right.
Other things, so like if you're doing a complete office renovation, any of those are like 100% deductible.
And
But
is that, can you take accelerated depreciation on renovations, or are you stuck with 39 years on major renovations?
so you can take, well, I mean, I think you have to consider like what a major renovation is. So like the idea is that you probably already have the office in your home, and if you're painting and maybe putting up some artwork, um yeah, if you're doing a build out, that's a different situation. That's going to be a business expense, but you're going to take that over the 39 years. Maybe you do a mini cost segregation study, but for the most part, that's going to be a 39-year asset that you have to depreciate. Um, Things like structural components, so like if you put like a new roof on, HVAC, stuff like that would all be subject to the allocation percentage, so 10 to 20%. Now the next thing is, how do you get the money, where does the cash come from? And I always advise clients to do at least a quarterly reimbursement from the business. And so all you're going to do is fill out a reimbursement expense form as you would if you were an employee. And I would say, submit that on at least a quarterly basis and have the business essentially make you whole again, and then that becomes an expense on the business income statement.
And what kind of documentation do you need to keep to be able to support this? Because some of these could be seen as aggressive deductions, right?
It doesn't raise red flags with the IRS unless you're being, if you're trying to tell the IRS that 80% of your home is a, home office, then maybe that's going to raise some red flags. But typically it's not going to be like a red flag raiser. But you do want to make sure that, you're keeping receipts and probably submitting those with the expense report. Um, Standard documentation that you would need to complete for the business expenses that you take. And the reason I say quarterly is because things happen throughout the year and you might forget about them. If you put a new roof on in January and then in December you're trying to remember all the expenses that you incurred throughout the year, you might be like, was that roof in December or January? When did that happen? And so I'd say quarterly keeps everything fresh. maximize those deductions, get the most bang for your buck.
Right. Because you might have paid a deposit the previous December, the job got done in January, you might forget when you paid the money, you got to go spend time looking it all up.
Yep, absolutely. So, um, now to take this a few steps further, if you can justify that your home office is your principal place of business, then now you can start deducting your commute. And so how do we do that? We would just take the miles driven from your home office to the other office to maybe a client site, and multiply that by the standard mileage rate. And again, the business is just reimbursing you for these expenses. So you might be able to add an extra $2,000 or 2,000 miles to your mileage reimbursement, which at 67 cents, I don't know what the current rate is off the top of my head, but you're looking at least over $1,000 deduction. That's $1,000 back in your pocket. So how do you justify that it's a principal place of business? I think you got to look at every situation, separately with your accountant. See, how much risk you're willing to take. I remember reading a case study once where a doctor in, I think, Boston, had a home office, reviewed, x-rays, scans, whatever, made all the business decisions from their home office. And the only reason they went to the hospital was to consult patients. But most of the business was handled at the home office. And so the IRS challenged this, and he actually won because they determined that the home office was the primary place of business. So it's a cool little trick if you want to try to deduct your commute.
All right, what's next on the list?
Let's see, what else can we do for home office? That's kind of the extent of it. We talked about the depreciation. We talked about the real estate side of things. We talked about the items in your home office. I think, again, the key here is to know that this exists, and that in today's world you probably qualify for it, assuming you have a place in your home that you can justify as a home office. And so if you're not taking this deduction, certainly something you want to take. I guess the other thing to mention is if you are a cash basis taxpayer, you want to make sure that at the end of the year you're submitting your expense reports and getting reimbursed for these expenses before 12/31. So we want to see the cash leaving the business and going into your pocket before 12/31. Otherwise, it becomes an expense on the following year. So if you reimburse yourself on January 1st, now you got to wait a whole year to take the expense for that.
One other question, Greg. These days, these accessory buildings that increasingly are becoming popular, basically nice sheds in your yard that some people are using as like studio, commercial studio space. How does it work with those? Because that's just, in theory, exclusively used by the business, so it's 100% allocated, right? How does that work?
So yeah, if you buy a shed and it's your business shed, that's 100%. So you can certainly take that. Obviously, you have to unless you have like a separate like utility line to the shed, then you need to allocate some of the expenses. But for the most part, you could even argue that like the increase in your real estate tax bill would be, whatever that difference is the deduction that you could take. But yeah, that's certainly an expense that you can take.
Awesome. And then I assume there's some good ideas to keep photographic evidence or journals every now and then to try to justify gray areas to help defend yourself in the event you are ever audited.
Yeah, you want to, photos are great. If you're using the home office only like 80% for business, you want to keep a journal of, what the portion that's business and the portion that's not. Yeah, obviously, like I said earlier, you need to keep the same level of documentation that as you would for your normal like operating business expenses.
Cool. Well, awesome, Greg. This has been hopefully very informative for listeners to try to clarify what is and is not deductible for home office expenses, as well as kind of how to go about doing some of those things. If folks have questions, want to talk one-on-one with you about their own situations, what's the best way for them to reach you?
You can grab some time on my calendar, smartbookstax.com. There's a link on the webpage. That's probably the best way to get a hold of me. You can email me directly at greed, GREED, at smartbookstax.com.
Awesome. Well, thanks for joining us again, Greg. We'll talk soon.
All right. Thanks for having me.
Bye. Another episode in the books. Thank you so much for tuning in. For show notes and more, visit empoweringhealthybusiness.com. If you would like to have a one-on-one discussion with me or possibly engage SmartBooks to help with your business, you can reach me at C-A-L, at empoweringhealthybusiness.com or message me on LinkedIn where I am easy to find. Until next time, this is Empowering Healthy Business, the podcast for business owners, signing off.